Have you ever wondered how companies manage their finances? That's where the concept of capital structure comes in. Now let's break this down. Capital structure is, essentially, the mix of a company's funding sources. It's a bit like a financial recipe, combining various ingredients such as debt and equity to finance a company's overall operations and growth. Think of it as a strategic decision that every company must make. They have to balance the advantages and disadvantages of debt and equity. On one hand, debt can be a cost-effective way to finance growth, but it also brings financial risk. On the other hand, equity avoids that risk, but it dilutes ownership and potentially control. It's a balancing act, and getting it right can be the key to a company's success or failure. Companies are constantly seeking the optimal capital structure that maximizes their value while minimizing their cost of capital. In simple terms, capital structure tells you how a company funds its operations and growth. So why does capital structure matter, I hear you ask? Well, let's delve into that. Capital structure holds immense significance in the business world. It's like the backbone that supports a company's operations and growth. It influences a company's risk and return profile, shaping the perception of investors and stakeholders. Imagine a company as a ship. The capital structure is the blueprint that determines whether the ship can weather a storm or sail smoothly in calm waters. A ship with a well-planned blueprint can endure turbulent seas, just like a company with a sound capital structure can withstand financial storms. Moreover, capital structure plays a pivotal role in shareholder relations. It can impact the return shareholders get on their investment, affecting the attractiveness of the company's stocks. But the magic happens when a company finds its optimal capital structure. This sweet spot minimizes the company's cost of capital, which is like reducing the price of the blueprint and construction materials for our ship. It also maximizes shareholder value, making the ship a more attractive investment. In essence, capital structure is not just about numbers and ratios. It's about strategy, stability, and sustainability. It's about making the right financial decisions that propel a company towards growth and success. The right balance in capital structure is key to a company's financial health and success. So remember, in the world of business, the strength of the ship lies not in the size, but in its blueprint. And that, my friends, is the essence of capital structure. But what influences a company's capital structure? Well, let's delve into the factors. Firstly, business risk plays a significant role. If a company operates in a volatile industry, it may prefer equity over debt to avoid the pressure of fixed interest payments. Next, the company's growth rate comes into play. Fast-growing firms might lean towards equity financing as they can reinvest their earnings into the business rather than spending on debt repayments. On the other hand, stable, mature companies may opt for debt as they have steady cash flows to meet interest payments. Profitability is another key factor. Profitable companies might prefer debt financing, as the interest paid on debt is tax-deductible, reducing their overall tax burden. Conversely, less profitable companies might prefer equity financing to avoid the strain of debt repayments. Lastly, market conditions can sway a company's decision. In a bullish market, issuing equity can be attractive as investors are more likely to buy shares. Conversely, in a bearish market, companies might lean towards debt. Remember, these factors don't operate in isolation. They interact with each other, and their impact varies from company to company. Each company's capital structure is unique, reflecting its specific circumstances and strategic choices. Let's bring this concept to life with some real-world examples. First, consider the case of the Philippines government. It's currently in talks with various banks regarding the structure of its planned maiden green bond offering. Here, the government uses bonds, a form of debt, to fund climate adaptation and mitigation projects. This situation shows how capital structure decisions are not exclusive to companies. Governments, too, must carefully consider the mix of debt and equity to finance their initiatives. Next, let's look at a corporate example. The private equity group Permira is in talks to acquire LivaNova, a medical devices manufacturer. The potential acquisition price is over $80 per share, valuing the company at around $4 billion. However, the activist shareholder Primestone believes that LivaNova could be worth more than $100 per share. This situation illustrates how capital structure decisions can impact a company's valuation. The mix of debt and equity in LivaNova's capital structure could significantly influence the acceptance of Permira's offer. Finally, let's turn our attention to China's fintech industry. Here, the top banking regulator has announced that financial technology companies will be required to meet capital adequacy requirements within a maximum of 2 years. This includes microlenders, consumer finance firms, and banks operated by internet platforms. These regulations illustrate how external factors, such as government policies, can affect a company's capital structure. In this case, companies may need to adjust their debt-to-equity ratios to meet these requirements. As these examples show, capital structure is a vital part of financial decision-making for companies and governments alike.